Good afternoon, everyone. This is Suzanne Friday at the Council on Foundations, here for our latest installment of our Legal Lunch series. I appreciate everybody dialing in for this. The subject today is DAF regulations and tax reform update. And I just want to say up front that if any of you dialed into our January 4th webinar where we talked about the tax reform law, you may see some slides that are similar. I'm going to go over some of the same issues, the same things that we talked about on January 4th as far as what's in the new tax law that is relevant to you guys as foundations. But there's going to be a lot of other good stuff too. And I'm going to really focus on a notice that came out from Treasury and the IRS right at the end of the year related to donor advised funds. So the first slide is just our normal housekeeping slide about accessing the help desk, asking a question, click the question box and type in a question if you have a question. We're going to kind of gauge how things go as whether we answer questions on the fly, but if I don't, we'll definitely get back to everybody that's sent in a question. And if you're on the telephone, please make sure to use the landline to ensure call clarity, and we are recording this, and usually the recordings are available in another day or two. So that's the housekeeping. On to the agenda. So as I said, one of the things I really want to do today, and we only have an hour, so hopefully we'll get through it all, is I really want to drill down on this Notice 2017-73, which came out right at the end of the year. You guys may have heard about it, you may not have heard about it, but we're getting questions. I also will go through tax reform, what has changed in the law and how it might affect your community foundation. And then some ideas, some tips about talking to donors with respect to what's changed in the law and how this is going to affect what you talk to donors about. I really tried to make an effort to pull out some practical suggestions and ideas for you guys because I think at the end of the day, that's really what's important. What does this mean for us? So as I said, we're going to focus at the beginning right now on this Notice 2017-73. The title, the formal title is Request for Comments on Application of Excise Tax with Respect to Donor Advised Funds in Certain Situations. And what this does, it's a notice that Treasury and IRS put out, and they're seeking comments from the field. So the council is going to submit comments. Anyone else in the field that has comments on what they're proposing can send in comments as well. The deadline is March 5th, 2018. And it's interesting that they use this form notice. A lot of times they will just issue proposed regulations and ask for comments on those proposed regulations. The notice is not written as proposed regulations, but it does give us an idea of what Treasury and IRS are thinking about three key situations that have come up with donor advised funds. And just as background, donor advised funds have been around for a long time, but since 2006, when we got the Pension Protection Act, we also got two new sections of the Internal Revenue Code, 4966 and 4967. And these put out a definition of what is a donor advised fund. It talked about how to do scholarships outside of donor advised funds. And it also put some rules on donor advised funds related to what they call taxable expenditures. These are distributions from your donor advised funds that could incur a penalty tax. And also what is an impermissible benefit or restrictions on distributions from donor advised funds that result in benefits to your donors or the donor advisors or related parties. And the language in 4966 and 4967, like much of the code, is somewhat general. It doesn't necessarily drill down into specifics as far as things like, well, what is a benefit? What is considered a more than incidental benefit? And we've been waiting since 2006 for Treasury regulations that will help us understand what they mean by things like impermissible benefit. This notice, like I said, we have no regulations to date on those two sections of the code. There are no regulations on donor advised funds and every year we're hopeful we'll get some. If anything, just for the clarity of what these two sections mean. But this notice, I think, is a positive step in that they're starting to really consider what they would put in these regulations. And the notice, again, is asking for comments, and it focuses on 3 specific situations. And Treasury and IRS have pulled these 3 situations from comments and information they have received from the field, including the council. The council meets with these folks regularly. We tell them what is of concern to our members, and particularly with donor advised funds, our community foundation members. And so they're hearing us, and we can see reflected in this notice that they're hearing some of these major concerns. So the first item that's going to be that's addressed in this notice is distributions from donor advised funds to purchase tickets to a charity event or to pay for membership fees in some kind of a charitable organization. The second item addressed is distributions from donor advised funds to a grantee, where the grantee will treat that distribution as satisfying a pledge made by the donor who had the donor advised fund. And the third item that they address in this notice is using donor advised funds to circumvent tipping rules for contributions to smaller charities. And I'm going to go over each one of those a little bit more. So this first item, distributions from donor advised funds for purchase of tickets to charity-sponsored events or to pay for membership fees. We get this question a lot, and the council, erring on the side of caution, has always advised not to make a distribution from a donor advised fund if the donor is going to receive tickets to some event or membership benefits as a result, because we feel that that would be a benefit accruing back to the donor as a result of the donor advised fund distribution, and therefore contrary to the provisions in 49, 66, and 67. We also are asked, well, what if the donor pays the ticket price directly and we just pay from the donor advised fund the difference? And I think we all are familiar with events where it may cost $1,000 to attend the event, but the dinner that you receive may only be worth about $100. So donors are getting creative and asking if they can send $900 from their donor advised fund and pay the $100 themselves. In this notice, Treasury and IRS have written that they currently review distributions from DAF for even just for the charitable portion of the event or the membership fee as a more than incidental benefit to the donor, and therefore would not be allowed under 4967. They specifically say you cannot bifurcate the two. They use the but-for test, in that if it but for the contribution from the DAF, the donor would not be able to buy the ticket itself. So they relate the two very closely, and they say that you cannot make distributions from your donor advised fund for this purpose. Now again, let me remind you, this is a notice. It is not regulations, it's not even proposed regulations, but they are letting us all know what their feelings are on the situation, and we have the opportunity to comment until March 5th to make some comments in this regard. The second item is the pledges, and this is where we see some helpful information in this notice, pledges and DAF distributions. So we, again, at the council have been very conservative on this issue, and we have always told our members that if they have a donor with a donor advised fund who wants to make a grant to an organization where they have already made a pledge to the organization, you cannot make that grant from the donor advised fund if that pledge would be some legally enforceable obligation of the donor. The theory being that you are now benefiting the donor by satisfying a legal obligation that they would have, and therefore you cannot do that from the DAF. What the notice says, and again, I think this is very helpful, the notice provides that the DAF sponsor, so that would be your community foundation, is not obligated to determine whether the donor advisor has made a pledge before sending the DAF distribution to charity. and the distribution will not result in an impermissible benefit to the donor or donor advisor, even if it turns out later that the donor did make a pledge to the charity, but they say that the following conditions must be met. One, that the sponsoring organization, so your community foundation, makes no reference to the existence of a pledge when making the DAF distribution. So you send that grant check to the grantee. In your cover letter, you cannot say this is intended to satisfy Joe Smith's pledge. Number two, the donor advisor receives no other benefit as a result of this distribution. And three, the donor advisor does not attempt to claim a second tax deduction for the distribution. So remember, the donors already received their tax deduction when they put the money in the donor advised fund. They can't take a second tax deduction from the grantee, even if the grantee happens to send them a gift acknowledgement letter. So if those conditions are met, you as the sponsoring organization can make a grant from a donor advised fund to a grantee, and you will not be penalized. And I think what they're trying to do here is give us some assurance that you won't be penalized, that it's not on you to ask a lot of questions and find out, is this a pledge? Is it a legally enforceable pledge? You don't have to contact the grantee and ask them about the status of any pledge. It kind of gets you off the hook for that. Now, I do want to caution, and there's an interesting sentence in this section of the notice. They say that taxpayers may rely on the rules described in Section 4 until additional guidance is issued. So what that's telling us is that we can all rely on this right now when we're making distributions from donor advised funds. So starting today, starting actually back January 1, you could rely on this guidance and, again, not have to ask a lot of questions about pledges and whether the donors made a pledge before you make a grant. But I said I want to caution you not to interpret this notice as just a blanket green light to start paying donor pledges with your DAFs, or to go out and market specifically to your donors and say, hey, guess what, we can pay pledges from your DAF. I don't think that's what's intended. I've talked to some of my colleagues in the field, and they generally agree that this is not intended to just be a blanket permission to use donor advised funds to pay pledges. But it does, again, give us the assurance that you're not going to get in trouble if it turns out that there was a pledge situation present. So I hope everyone feels at least a little bit better about that situation. Then the third item is the use of a donor advised fund to support small charities, but in an effort to avoid tipping. So just as an example, you might have a donor who loves a very small charity and wants to give them a lot of support. But under the public support test, if he gave a lot of money directly to the charity, they could fail their public support test and be reclassified as a private foundation. So to avoid that, the donor can put money in a donor advised fund and then advise you as a sponsoring organization to make a grant to that small charity. A grant from a public charity like a community foundation, even if it comes from a donor advised fund, is not subject to limitations. There's a 2% limitation on contributions from individuals when a charity is determining its public support. But that limitation doesn't apply if it's a grant from another public charity. So I think it's not uncommon for donors to use their donor advised funds to make grants to smaller charities that might otherwise tip them over to private foundation status if the grant or the gift were made directly. Treasury and IRS don't particularly like this, and they've addressed this in this notice. They state that they are considering treating donor advised fund gifts to grantee charities as if they were coming from the individual donor. So basically what they want to do is disregard the sponsoring organization and not view it as a grant from a community foundation, but view it as a gift directly from the donor. This would mean then, just as other gifts from individuals, it would be subject to the 2% limitation, and therefore only part of it can be counted toward public support, and it would not skew the public support test. They are considering changing the regulations to reflect this, and this is really important for the grantee. So your small grantees, those small charities that you make grants to, are the ones who are really going to be affected because they're the ones who are doing your public support. You as a sponsoring organization don't have any risk in this. You can still make the grants, but it's for the grantee to properly calculate their public support if a rule like this comes into place. Now, as the sponsoring organization, a couple of other points they have in this notice, they state that all anonymous contributions from the sponsoring organization are going to be aggregated and treated as if coming from one individual. So if your donors think that they can make these contributions anonymously, that's not going to help. So even if you have several anonymous donors, you're going to be required to aggregate them and treat them as if coming from one individual, and therefore subject them to the 2% limitation. There is an exception to treatment of a grant from a sponsoring organization. So I don't want you guys to worry that any grant that you make to a small charity is going to be subject to these rules. Again, these are only for DAF grants. And if you as a sponsoring organization specify when you make your distribution, when you make your grant, if you specify that it doesn't come from a DAF and that no donor or advisor has advised you about making this grant, then you don't have to worry about it, and the grantee doesn't have to worry about it. But again, you have to actually affirmatively state this is not coming from a donor advised fund. And if it does come from a donor advised fund, you don't want to make a false statement. So this is only going to help you with your grants from other fund types like designated funds or field of interest funds. So that is basically the three big ticket items in this notice. And it looks like that we have some questions already. The first question I see says that the pledge issue sounds like a don't ask, don't tell. And doesn't that erode our relationship with and communications with donors? You know, this is a great question, and I have heard already that don't ask, don't tell phrase being used. And I can see some people could look at it that way. But I think, you know, when it comes to donor relations, the best policy is honesty and letting them know this is what IRS and Treasury are thinking, and that you guys want to abide by the rules, and you're going to make these grants in good faith, that there's not a pledge involved. So, you know, you're right, it puts you guys in a tricky donor relations situation, but on the other hand, it does give you some assurance that you're not going to be penalized for making an improper grant. Let me look at some of these other questions. One of them asked, should we look at that third point as if it were already in place? That's a great comment or question, and certainly to be on the conservative side, you can do that, and you may already be doing that. But it's not required by law right now, and there are a lot of people who utilize donor advised funds to make grants and provide some significant support to small charities. My bigger concern is when your donor has a real connection to that small charity. So your donor's either on the board or maybe a family member runs that charity. That's when I get really concerned. And I'd like, when I sit down to write my comments on these, I'd like to point out that difference to Treasury and IRS and say, hey, look, it's one thing if a donor just likes a small charity and wants to give them support. It's another thing if the donor's daughter is running the charity and is wanting to give them support to support their daughter. And I think those two things should be distinguished. But you're right, if you're already very cautious in this area, I think that's great. It looks like that's what's coming. But right now, as of today, it's not the law. Let's see. I'm looking at the questions here. How would the grantee know if a grant were coming from a donor advised fund or from a specific individual? In my experience, most community foundations, when they send a grant to a charity that is coming from a donor advised fund, will identify that. It will say, we are pleased to provide you this grant from Joe Smith's donor advised fund here at the community foundation. So that is being provided up front. If you're not doing that under this guidance, if this becomes the rule, if this becomes a true regulation that we would have to follow, you would have to make the affirmative statement that it's not from a donor advised fund. So if you can't make that affirmative statement, then I think the assumption would be that it is from a donor advised fund. And then there's a question about, let's see, considering regulations about tipping. Do our non-DAF grants need to include the affirmative statement and that it's not from a DAF now, or can we wait till they're finalized? Yeah, you can certainly wait till these become final regulations if they do. And please remember, again, we have a comment period. So if they get flooded with comments, these might change somewhat. But I don't think you need to change your gift acknowledgement or your grant cover letters just yet. I think I have that at the end of the presentation. I think I have an idea about that, but you know, something to keep in mind, and we at the council will certainly keep you posted if and when these become actual regulations. So I'm going to move on now. Hopefully I've answered some of the pressing questions, and again, if I didn't get to your question, please follow up with me. My contact information will be on the last slide. And the next part of this is about the tax reform. So we all know that a very big tax reform bill was passed at the end of the year, and on our January 4th webinar we did go over what's in it, what's not in it. There were things that were proposed that didn't eventually get into the new law, but I just want to point these things out again to you because then that will help us give background for the final part of this presentation. So here's a little chart that my colleagues in our Government Relations Department made up. You can see under the What's In column, the new law has lowered the individual income tax rates with the exception of the lowest rate, is still 10%. They've increased the standard deduction, which we're going to talk about in a minute, and it's going to be important to you guys. There are also fewer itemized deductions now. Itemized deductions include the charitable deduction, which is good, but it includes mortgage interest deduction. There is a limitation on state and local income taxes. And what this means is that a lot of people are no longer going to itemize. I think that the increase of the standard deduction is going to be more favorable when you're doing your taxes. They also eliminated the deduction for amounts paid for college athletic seating rights. And I threw this in here just because I know as community foundations this really doesn't apply to you, but some of you out there may have heard a donor or someone tell you, oh, well, I can make a gift to my university and claim 80% as a tax deduction and 20% would not be deductible because that's the rule when you're making a contribution that entitles you to buy season tickets or something. Well, they've done away with that, and they've said that if you are entitled to seating rights, something like that from your college or university, that payment is completely not deductible. So that's something to be aware of. If you hear it, that's no longer correct. There is an increase in the adjusted gross income limitation for cash gifts. That's gone from 50% of your adjusted gross income to 60% of your adjusted gross income. And that's for cash gifts to public charities and certain other organizations, but not to private foundations. The private foundation limitations did not change. The law has also doubled the threshold for estate tax. So before it was $5 million, it's gone up to $10 million, which is actually a little bit higher because it's already being adjusted for inflation. Another thing that that I think is a little bit alarming is this treatment of unrelated business income and business activities. So if you're a community foundation and you engage in any unrelated business activities, you used to could aggregate the business activities together. You file a 990T, and you can aggregate the income you earn and the expenses that you pay, and come up with an amount that you would pay your unrelated business income tax on. You can no longer aggregate different activities. You now have to calculate the unrelated business income tax on each separate activity. So if you're doing a couple of different things, you have to now calculate each one separately. The other part of this UBIT, these UBIT provisions, is that certain employee fringe benefits are now going to be subject to UBIT. And you may be saying, wait a minute, I don't understand. It's not income. In fact, it's something we pay. And the benefits are transportation benefits and employee gym membership. If you provide a gym for your employees, those are the benefits that you now have to pay tax on. So if you're doing that for your employees, you're going to have to file a 990T, show the amounts you pay for those benefits for your employees, and then calculate a tax on it. So it's different from unrelated business income, and you would normally calculate what the income from the business is. But this is a way, it's a money generator, I think, for Treasury. And also, I was told that it's to kind of even the score, because they've taken that deduction away from for-profit businesses, so they wanted to do something similar for the nonprofit sector. Then the last thing is a charity executive compensation subject to an excise tax. Compensation over $1 million is now going to be subject to an excise tax. What did not make in the final bill is anything about the Johnson Amendment. So we still have the Johnson Amendment in place. Anything about donor advised funds, and the simplification of the private foundation excise tax. Those were all things that were proposed, particularly the IRA rollover for donor advised funds. We at the council really fought for that, and it did not end up in the final law. A little bit more about this, again, lowering the individual income tax rates. The increased standard deduction is now $12,000 for individuals, $18,000 for head of household, and $24,000 for married filing jointly. That's about double of what the standard deduction is now. So, you know, people are going to have to look at, when they sit down to do their taxes, what's better for me? If I itemize my mortgage interest and my charitable gifts and $10,000 worth of state and local income tax, or if I take the $24,000 standard deduction. And in a lot of cases, the standard deduction is going to be better. So they're not going to itemize, and that may make them less interested or less motivated to make the charitable gifts, because they're not going to be able to take advantage of the charitable deduction. I talked about the eliminating the deduction for amounts paid to colleges for athletic seating rights, the AGI limitation, and the threshold for the estate tax. I think the estate tax, you guys are going to see some fallout from that. I think individuals now have a much higher threshold before they have to pay estate tax, so they may be reconsidering some charitable gifts that were intended to bring them under the limit. We talked about the UBIT, and again, the UBIT provisions actually went into effect January 1. So if you need more information about this, let me know, particularly if you've never filed a 990T, if you've never engaged in any unrelated business income activities, and if you are providing transportation benefits, whether it's parking or Metro cards or something like that to your employees, or you are providing them access to a gym or health club facility, you might get caught up in this, and now all of a sudden you're going to have to file a 990T. So if you need more information about that, let me know. There are ideas floating out there about possibly asking for a delay in the implementation. This did go into effect January 1, but if we could get a delay in the implementation, possibly for a year, to allow everyone to kind of decide what they want to do, that might be helpful, and we're talking about that here at the council. That is, yeah, the charity executive compensation, again, imposing an excise tax on tax-exempt organizations with executives receiving compensation in excess of $1 million. And the $1 million includes actual salary plus the value of benefits. The excise tax would be 21%. If any of you are fortunate enough to be in that category, you might want to be aware of that. And again, what's not in the legislation was the Johnson Amendment, no weakening or repeal of it, no provisions that would directly impact or change the administration of DAF. The notice that we spent a lot of time talking about is something different. It's not in the law. It's regulations that may be coming, but there was nothing in the tax reform law. And there was nothing about the simplification of private foundation excise tax. There was a lot of talk and proposals about simplifying. Right now, private foundations have a two-tier system where they either pay 2% or 1% depending on their grant-making activity. And there was a lot of support for, let's just simplify this. One of the proposals was having a flat 1.4%, but that did not make it into the final law. So the last part of my presentation, and I'm going to pause for a minute and look at the question board. Let's see, that's about, looks like most of the questions were covered already when we talked about the notice. There is a question about what's the likely timeline for turning these into law, and I'm assuming this is related to the notice and the proposed regulations. So we've got the comment period open until March. So nothing's going to happen until the comment period closes. Then Treasury and IRS are going to have time to review the comments. But I would say probably by end of summer or fall, early fall, we might see some regulations. Now, it's unclear. I'm assuming they're going to start with proposed regulations, and they're going to put out the proposed regulations in the regulatory language, and there may even be another comment period to that. If this notice is intended to skip that, I would be very surprised. But I think we're looking at fall, end of year before we have these in place. And of course, we will keep everyone posted on the progress of that. And also, I would make a plug that if you have comments, if you want me to relay comments, I am definitely going to be sitting down in the next few weeks and starting to draft my comments. I have quite a lot to say on these things based on all of my wonderful conversations and emails with you guys. But I would love to hear your input, and I can am more than happy to be your voice with Treasury and IRS on this. So I want to go back to the tax reform law and what this means for your day-to-day. I think this is going to have some effect on how you talk to donors about their tax planning. So if you're in development, if you're a planned giving officer and you're talking to donors, helping them think about their tax planning, some of the ideas, some of the things you might want to think about now are ideas like bundling gifts to use the charitable deduction in some years and taking the standard deduction in some years. If you have donors that make smaller gifts, maybe $5,000 a year, and the standard deduction is now going to be more advantageous for them when they do their taxes. One of the ideas is, well, hold that $5,000 and give us $15,000 every few years, and in those years itemize and take advantage of your charitable deduction, but in the other years use your standard deduction. That's an idea, again, a planning idea that you might want to keep in the back of your mind. Donor advised funds are a great vehicle for this. So if your donors are interested in making larger gifts every few years, what better place to put them than a donor advised fund, where the money can be held and they can make the grants annually. They can continue to make their grants annually to their favorite charities without losing the benefit of the tax deduction. Gifts of appreciated capital gains property is still advantageous. Nothing's changed on that point. So if people give you appreciated stock, they can avoid the capital gains, and that may be something, again, that would sway a donor as far as what they want to give. But the higher AGI limit on cash gifts, so again, it's gone from 50%. If a donor is making a large cash gift, they can, under the old law, they can deduct it up to 50% of their adjusted gross income. Now they can deduct it up to 60% of their adjusted gross income, and that may sway some donors to either make a little bit larger gift or plan their gifts accordingly. Other considerations, so again, the increase in the estate tax exclusion might change your planned giving strategy. You're now looking at donors who have a $10 million exclusion limit. And so the information you provide is not going to be the same anymore as when it was $5 million. The IRA rollover provisions are still the same. Unfortunately, we did not get the IRA charitable rollover extended to donor advised funds, but as community foundations, you can receive the IRA charitable rollovers to any other type of funds that you have at your community foundation. And we know that this has been a popular tool for a lot of donors. It can now be even better, I think, or more advantageous for some donors, because the IRA charitable rollover does not depend on a charitable deduction. What the IRA charitable rollover does is it completely bypasses the donor's income. The money goes straight from the IRA company to your community foundation. The donor never includes it in income and therefore doesn't have to pay any tax on it. So again, the charitable deduction isn't involved here. And this may be a better way now for some donors to give to the community foundations using the rollover, because if they're not itemizing and they're not going to take advantage of the charitable deduction, an IRA rollover may be a better idea for them. Again, I said understanding whether your organization needs to begin filing a 990T for unrelated business income. Again, the benefits issue are really just the transportation benefits and the health club benefits. If you don't do that for your employees, that's fine. You won't have to worry about the 990T if you don't have other unrelated business activities. If you do have unrelated business activities, you're going to need to look at those activities and see whether they are separate type of business activities that need to now be calculated separately. Of course, all of this is not just affecting you guys as community foundations, but will affect your grantees as well. Grantees are going to be in the same boat as far as people may not take advantage of the charitable deduction. They may use the standard deduction. Giving may drop. I purposely did not provide some of the statistics. There have been some studies done recently about what the projections are and how much this is going to reduce charitable giving. I didn't want to go there. I'm not about projecting what might happen, but I think we will see some differences. And again, your grantees are going to feel those differences just as much as you are. So you're probably going to get more requests for funding, and that's something you could possibly use with your donors, and make sure your donors understand that everyone is kind of in the same boat here, and that you guys as community foundations could be really great vehicles to be helping these other charitable organizations. And as we hear about other federal and cutbacks, we all know that there's going to be more need. I think we can all agree that there's going to be more need. The last item I had on this page is a little blurb about crowdfunding platforms. Every now and then I will get a question from one of our members about donors who are wanting to do GoFundMe pages and different crowdfunding sources for charitable causes. I think this is interesting because if the charitable deduction becomes less important to people, to donors, because they're using the standard deduction, they're not itemizing, it will be interesting to see if more donors turn to crowdfunding sources because they realize, well, I'm not going to get a charitable deduction anyway. I want you guys to keep that in your mind as far as how you might be able to coordinate with that if it's something that's happening in your community. Again, you know, we all have to kind of wait and see how this all plays out, but I think there's definitely going to be some new ideas and new attitudes about charitable giving, and I wouldn't be surprised if crowdfunding type programs spike in more contributions. And this is actually a follow-up to one of the questions. So I put on here, if you go back to the notice, remember the notice and talking about grants to grantees to the small charities and whether or not it comes from a DAF. It's something to think about for the future, and I applaud the person who sent in that question because they're already thinking ahead. But we may want to eventually consider incorporating language in our grant cover letters to identify whether this is a grant from a DAF or not from a DAF, to help satisfy that requirement. Again, if these regulations come into being, and I'm not saying they're not here now, but if this happens in the future, we probably will need to make some changes to things like your grant cover letter to identify what type of fund your grant is coming from. So there, this last slide is a little plug for our Public Policy Summit in April. I think that the tax reform, the new law, things like this notice are great examples of how our voice needs to be heard. And in our Public Policy Summit that we're going to have in Philadelphia in April, it's a chance for you guys to come and learn about how to do policy work, how to be involved in that, if it's something that interests you and you want to make a difference. So now we've got about 15 minutes, and I'm going to look at the questions and see what we can address here in the questions. And it says, would the identified fringe benefit be subject to UBIT for a community foundation or just a private foundation? The unrelated business income tax that's going to be imposed on these types of fringe benefits apply to all nonprofit organizations, whether you're a public charity or a private foundation. So either one will have to file and pay the tax if you are providing those benefits for your employees. Let's see. A question about how would, okay, regarding unrelated business activities separately, how would this impact unrelated business income realized through investment in pass-through entities? Will we need to treat each partnership as a separate activity, or is investment in private capital an activity in itself? So investment income has always been an exclusion to the UBIT rules, and that has not changed. But if you're a partner in a partnership and you're getting K-1 income, or you're a member of an LLC and you're getting K-1 income so that you're actively participating in the business, then yeah, you have to calculate that as for unrelated business income tax purposes as a separate activity. Now, if you're in, for instance, if you're in two different partnerships and they do the exact same thing, the question has been raised, can you aggregate those? And unfortunately, I don't have an answer for this. I don't think there is an answer as of today, but it has been a question that is raised, is what's related and what's not related. And so we are asking Treasury for clarification on that issue as soon as we have a more clear guidance, we will provide that. Let's see. The P's limitation, great question. The P's limitation, I think that has been done away with. Oh, I apologize. I think that is no longer in the new tax law. And the P's limitation is a limitation on itemized deductions for much higher income individuals. And I believe that has been taken out. I will clarify that if you want to email me directly. Let's see. Is it correct that repeal of the Johnson Amendment is still being talked about? Oh, another great question. Yes, you are correct. Even though it didn't get in the tax reform bill. And I want to say that some of these provisions did not get in the tax reform, the final tax reform bill, because of some technical rules that the Senate and the House have. I don't try to make anyone believe I know all of the ins and outs of their rules, but there were some rules kind of last minute where they had to take some things out because they violated the Senate rules on certain things. And I think the Johnson Amendment fell victim to that, or their attempt to repeal the Johnson Amendment was taken out because it violated, I think it's the Byrd rule, that says you can only have certain things in this type of bill. So to answer the question, yes, you are correct that that is still being talked about. I think there is still some support on the Hill to try and repeal it or modify it. We also still have President Trump's executive order from last spring, which kind of said basically he would not want IRS to enforce the rules against political activity by churches and similar organizations. So that's also still out there. But we could see the Johnson Amendment issue raise its head again in the near future. Let's see. There's a question that says, would the council consider raising a point that local community nonprofits might be harmed by the rule that would aggregate DAF gifts? Local community foundations receive recommendations from a wide range of unrelated individuals, and totaling them could easily tip a small charity. So to answer that question, the aggregation is only if your donors are wanting to do this anonymously. And the thought is that a donor, normally in most cases, a donor has a donor advised fund at the community foundation, and they tell the community foundation, I want to make a grant to this charity. And the check is sent and a letter is sent with it that says, we're pleased to provide you this grant from Joe Smith's Donor Advised Fund. If the donor thinks that by asking you to keep him anonymous, he's going to avoid that identification as a donor advised fund grant, Treasury and IRS wanted to address that. And their way to address it is to say, okay, fine, if you want to be anonymous, and there are others who are also anonymous, we're going to aggregate them and treat them as one person, even though in reality they're a bunch of different people. So the way to deal with that is to not be anonymous. And you can send donor advised fund grants to any qualified charity. And if you're identifying them as a donor advised fund grant and identifying the individual, then yes, that grant is going to be subject to the 2% limitation. But if there are a bunch of smaller gifts, then hopefully that 2% limitation is not going to tip the charity, the grantee, over into private foundation status. So I don't want it to confuse anyone that I'm saying all donor advised fund grants must be aggregated. It's only in circumstances where they're anonymous and you can't tell if they're donor advised fund grants or who the donor is, then that's when you have to aggregate them under these proposals. Let's see. A question, are there concerns that private foundations should be aware of regarding who serves as an advisor to a DAF? This is actually a great question because, and I've had conversations about this before. So when you have a donor advised fund that is established by a private foundation, your private foundation is the donor. The individuals who may run the private foundation are not necessarily your donors, but the private foundation is the donor. So you look at the private foundation as your donor setting up the DAF, and therefore private foundations are already subject to the 2% limitation if they gave a gift directly to the charity. Under this new proposal, they would be still subject to the 2% if they flowed the gift through a donor advised fund. You may also, in private foundation world, the major contributors and board members are considered related parties, and so it's going to be interesting to see when the proposed regulation language comes out, how they attribute all of this to related parties as well as to the private foundation. But this is going to be important for private foundations who also want to avoid the tipping issue and are using donor advised funds to do that. I think this was one of the big concerns that Treasury had, and maybe one of the reasons that prompted this proposal is because donor advised fund or private foundations may have been avoiding the 2% rule by using the donor advised fund to fund small charities. Let's see. Question about the unrelated business income tax for the transportation, parking, health club benefits. Yes, I think the way we read it, bus passes, parking are going to be included. We are going to draft some more specifics about that, and we'll have that up on our website soon if it's not already there, to tell you exactly what the benefits are, but it's pretty broad when it comes to transportation benefits. So it's not just your Metro card, it's any kind of subsidized parking and other transportation benefits. Let's see, back to the notice, mentioned that a grant from a designated fund would not be considered a grant from the donor, but rather from the public charity. Yes, that's correct, because it's not a DAF. But do you think the IRS would argue that a designated fund is earmarked for the charity and that grants from it should still only count as coming from the donor subject to the 2% limitation? Hey, Corey, great question. Don't say that out loud. I think our argument, our counter argument to that would be that designated funds for specific charities ideally also attract contributions from other donors, right? If you're a community foundation and you have a designated fund for your local animal shelter, ideally lots of different donors will contribute to that designated fund, and because of that, it's certainly not the same as a donor advised fund. And even though the original donor may have started the fund, you're not giving that donor advisory privileges, and it's not the same as a donor advised fund. So I certainly hope that they don't go that far. I don't think they will. I think donor advised funds, and specifically as they're defined in 4966, are recognized as such, and so other types of funds will not be affected. I think you can answer the same question about field of interest funds, or ask the same question about field of interest funds, particularly if you have a field of interest fund where a donor might participate on an advisory committee. Could the IRS and Treasury go there? And again, I certainly hope not. I do not think they will. I think they really are just looking at donor advised funds. You know, that's an interesting thought and a little bit of a scary thought. Let's see, about 5 more minutes. Can you please review the page on charitable events or send those slides? We will certainly make the slides available. But again, what they're saying in the notice, just as kind of a recap, if you have donors who have donor advised funds, and you are ever asked by a donor to make a grant from the donor advised fund to make a sponsorship payment or a contribution to an event, and events like hospital galas and museum openings and big fundraising events where the hospital or the museum is looking to donors to contribute $1,000, and in exchange they get a ticket or admission to the event. Under this notice, Treasury and IRS are saying that you cannot pay that from a donor advised fund. You can't even bifurcate it. You can't even pay the $900 from the DAF and the $100 from the donor directly, that they view those as so interrelated that it's a benefit to the donor that they get to go to the event because of the contribution that the donor advised fund is making. And they are saying that if they were to write the regulations right now, they would not allow it, and that would be an impermissible distribution from a donor advised fund. So these are the kind of things that we can certainly submit comments about. That one comes up a lot in my day-to-day question and answers with our members. I'm going to have something to say about that as well. The argument, a lot of people put, the argument is like, well, the donor could do that directly. If the donor made a $1,000 contribution to the event, the donor could take a $900 charitable deduction. Why can we not do it through a donor advised fund? And I don't have a good answer for that. That does seem a little odd, but it goes back to the rule that distributions from a donor advised fund cannot result in a benefit to the donor. And I think that's what they're looking at. They're looking at this as a benefit to the donor because of a distribution from the donor advised fund, and that's not allowed. So with that, I'm going to wrap it up. I think we're about at time. I really, really appreciate all the questions. I'm going to look at the questions when I sign off and try and answer. If you want the slides, please let me know. I'll send them to you. The recording should be up in another day or two. And I hope this has been helpful, and I appreciate everybody dialing in.